Well, it's a Monday afternoon. Now let's get to our conversation. The Central Bank of Nigeria has started already as we speak the 302nd Monetary Policy Meeting. This comes as the Center for the Promotion of Private Enterprise urged for an interest rate and cash reserve ratio quote. The 302nd two-day MPC meeting in Abuja comes at a time when CBN Governor Olayemi Cardoso and the deputy governors are marking their second year anniversary. The MPC would need to take key policy decisions regarding inflation and interest rates. Stakeholders in the financial sector and Nigerians await the MPC's next line of action after the country witnessed its fifth consecutive decline in August, which was at 21.12%, and interest rates at 27.50% since July. Despite the decline in inflation, data experts say prices of goods and services remains high in Nigeria. Well, let's start the week and talk to Mr. Johnson Chukwu, who is the founder, Group Chief Executive Officer of Cowrie Assets Management Limited. Mr. Johnson Chukwu, it's good to start the show with you. Thank you so much for being on the show.
Thank you, Tolu, for having me. Good day.
Yes, good day to you. What do you think? I think it's good to start our conversation this afternoon that way. The meeting is on already in Abuja, and it's a very important one after what we've seen with regards to inflation. What do you think will form our conversation around that table today as the CBN governor meets with all of the Monetary Policy Committee members in Abuja?
Well, I think the major thing they will consider is that they will start by looking at the global economic trend, the global economic direction. They will look at the price of crude and the demand for crude. They will look at internal or national economic parameters such as inflation rate, exchange rate, and the pressures on the exchange. They look at the build-up on reserve. So if you take each of these issues I've mentioned, take for instance the national global economy. Of course, we saw most central banks cut interest rates in the past couple of days. We saw the Federal Reserve Bank cut interest rate by 25 basis points. We saw the Bank of Ghana cut interest rate by 350 basis points after a previous cut of 300 basis points. We saw several central banks at the worst hold rate. There was no further tightening. So if you look at that, so you will see that the direction of interest rate reduction globally. Then you look at global economic output, what could spike inflation. You see that there's a slowdown in real sector productive activities in manufacturing sector in China, which is indication that crude prices could moderate at the time when OPEC is increasing crude prices, crude volumes. So it's likely we're going to see moderation in crude prices. What that means is that for us, our earnings, and we also saw a decline in crude production. If you look at the first crude production for August, it was about 1.6 million barrels a day, including condensate. So you look at that, what could be the implication of that? Is that one, you could see a slowdown in reserve accretion. We're at about $42 billion. But you ask yourself, is that going to be very steep? The answer is no. Then at the local environment, you look at inflation rate. Inflation has moderated about 20.12%, down from 24.45% it was at the beginning of this year. We've seen Naira stabilize, Naira traded below 1,500 Naira in the past couple of days. And we've seen a consistent appreciation of local currency at the time when we are seeing accretion in reserve. Then on a more positive note, we saw a balance of trade of about 7.4 trillion Naira in the second quarter of this year. And that is coming from a period, earlier first quarter, trade balance of about 5 trillion positive balance of trade, which means that we are seeing a proper and more enduring accretion in our reserve. So if the central bank put all this together, what they will say is that the economy has achieved some level of stability, exchange rate has stabilized, it's strengthened, inflation has moderated. So what should be the net focus of government? And that focus should be, let's drive real sector productive activities. Let's increase the level of economic activity so that we can create employment. and produce more goods and services that will even put in play inflationary pressure at the bay. So I think the Monetary Policy Committee will focus on what are those policy decisions they will take that will bring down, that will stimulate greater or faster economic activity. And that should be that they should shave off some percentage points from the current monetary policy rate.
That's the big question. Do you think that, considering all other fundamentals surrounding these figures, that the Monetary Policy Committee might begin to want to consider that shift from this meeting? I've had analysts like you that have said we should expect a shift maybe from the next meeting in November. Some even said early 2026. That's when we could get a shift. Do you think that the fundamentals are right for that shift at this time?
Well, so looking at the factors I mentioned,
yes,
and if we take even the standard factor, assuming we are actually a strong, productive, and export-oriented economy, there would have been a more compelling reason for us to even have cut rate earlier, like Bank of Canada did, that they did. And by cutting rate, I said we need to stimulate local consumption and stimulate production, because the US, that's one of our stock markets, is slowing down their demand for our goods. So if the US Reserve Bank and most central banks are cutting their rates, it's also time for you to cut your rate. Otherwise, you're going to see only hot money coming to your place. But most importantly, what it matters is your local economic variables. The local economic variables all support rate cuts. Inflation has moderated significantly, about 20.12%. That is material given where we're coming from. Bear in mind that last year, average inflation was about 33.18%. So, two, you no longer have so much pressure on exchange rates, and you have built reserves about 41.99 billion, which call it average approximately $42 billion.
Yeah.
So, what should be your next focus? You will say that to a reasonable extent you have tamed inflation, and what you should be the next thing, how do we stimulate economic growth rate? Let me tell you, Tolu, one of the greatest challenges we have is that we are not really producing enough goods and services. Because if your economy is very productive, you realize that the high rate of inflation that we have today will not be there. If you remember that simple definition of inflation is that more goods are pursuing, a lot of more money is pursuing few goods. So if you produce a lot more goods, then you're going to see a moderation in inflation. So, and that should be the target of the government. If we ever aspire to have a single-digit inflation rate, then it will come from an economy that is productive, not an economy that is starved of cash, but an economy that is productive. So I think what they should focus on is how do we stimulate economic growth, economic development, how do we encourage employment, and we come from lowering interest rate. So I think this one is the most auspicious time for them to lower interest rate. There's actually nothing they are waiting for. Are they waiting for Naira to get to 1,200 Naira, or do they want inflation to go to single digit before they lower interest rate? Bear in mind what I said, that if you have a productive economy, naturally you will have a single digit inflation rate. But we don't have that. I think the Monetary Policy Committee need to signpost that change in direction and say, look, our focus is now more on increasing productive activities.
Price of foodstuff is one thing that all Nigerians like to always hear about. I'm looking at moving forward. When inflation, we see another two-in-one question I'm going to ask this next one. What do you make of the present price? Do you see a bit of decline? Because some analysts have also said, well, in some cases, price of tomatoes, price of yam, price of some of this foodstuff are coming down gradually. How significant? What do you make of what you've seen with regards to drop in price? Then some say what we have is disinflation and not deflation. How do we marry this together?
Okay, let me start from your first question. Price of things like tomato,
yam, tubers.
Tuber are coming down. The simple is that we do not have storage capacity, and this is the peak of the harvest season. Because many of these things like tomato are perishable commodities, food items. So if you produce them today and you're not able to store them, you don't have the refrigeration systems to store them. So you must sell them as you produce them. And at the point when you produce more, which is simple, that simple logic of economics, the more goods are pushing for money. If the production is outstrip the daily demand, then prices will come down, which is why price of some of the items you mentioned are coming down, particularly the crop and the fruits, whose production is massive during this period, and we don't have storage capacity. So what that means is that when we go beyond the harvest season, their prices may not continue to come down. You may see some level of reversal. I don't think those reversals are going to be very steep, but I think we may see some reversals. When the harvest season ends and we move to planting season, then the farmers will be looking for yam seedlings to go and plant. And they will, the way they cut the yam and turn them into seedling. So at that point, the demand pressure will be higher and prices will go up. Then on the issue of disinflation and deflation, disinflation is when the rate of inflation is increasing at a slower rate than the preceding or previous periods of measurement. For instance, if you say inflation rate for last year was average 33.18%, or inflation went 24.5% in January, and it's now 20.12%. So that's a disinflation, which means rate of increase, prices are still increasing, but at a slower rate, at a slower pace. Okay, but deflation is when the prices are declining. Like you go to the market today, you buy a food item for, let's say you buy same size of yam for 300 naira, and you come back the next day, become 250 naira. That's deflation. Deflation hardly happens in most economies. Where it happens, it's always a major problem because it destroys investment. But we are far from there. So, but what Nigerians, when they hear inflation is moderating, they think you are talking about deflation, and they say, they talk deflation. They go to the market and say, but prices are still going up. What we're saying, the prices are going up at a slower pace than they were going up the previous period of measurement, maybe previous month or previous year.
Let's move another step forward. The target is 15% inflation to end the year 2025. I know some analysts like you have said, that seems to be like a tall order if that will happen, considering this trajectory that we are following at this time. But in your own understanding, Mr. Juku, what do you make of projections as we move towards the end of the year? We're getting to the last quarter already.
Well, we should expect inflation may still moderate in the month of October and maybe November.
Okay.
But I think after that,
December,
we're going to go past the harvest season, and then we should expect that it will become a bit obstinate. So I don't see how we're going to achieve a 15% this year.
So that's really not feasible. What about other indicators that we expect as we go towards the end of the year?
Well, I think the other factors you need to look at is that we've talked about inflation. Let's talk about exchange rates.
Yes, there's been a bit of stability.
We've seen some stability in the exchange rates. And I think with the CBN's posture, we may see a further appreciation in the exchange rate towards the end of the year, particularly when you move to December, when a lot of diaspora remittances come home. Remember that from October, a lot of Nigerians in diaspora begin to send money. Those who want to renovate their house, who want to repaint, who wants to prepare for their homecoming. So we should expect a further increase in foreign currency liquidity as we approach the year end, and then that means that Naira will continue to strengthen. And also bear in mind that this is the last period for importation of goods for Christmas sales. And because, of course, we're already dealing with a very low demand, so orders are not placed in September and October will not be placed for December. So in November, December, the demand for Forex by importers is also very slow. In summary, I'm saying that, look, Naira will strengthen further towards the end of the year. What other factors you look at? We talked about inflation, exchange rate, unemployment, productivity. In terms of productivity, it depends on what the Monetary Policy Committee does. We are dealing with a very low productive economy because of several limiting factors, including high cost of borrowing. So I think the Monetary Policy Committee is in a position to reduce the cost of borrowing, either by reducing monetary policy rates or reducing the cash reserve ratio of 50%. That way, we'll be able to provide liquidity to encourage these sector productive activities.
That would be a good one for the real sector. Manufacturers, business people have been complaining about this high interest rates. Some will clearly tell you that, how do you expect me to make profit if I'm borrowing far above 30%? And that's really worrisome. Let me ask you about, what about the low purchasing power of Nigerians? That is also something that many have talked about. When you have a minimum wage of about 70,000 naira, though in some cases, some states are paying more than that, and considering the reality on ground, do you see us growing as expected? We are talking about a $1 trillion economy, Mr. Chukwu.
Well, to really start by taking the issue of $1 trillion economy, the $1 trillion economy rated for 2030. This is 2025 that we're almost out of. So we are talking about 5 years. And the economy, based on the NBS report, when they rebase about $247 or so billion dollars. So there is no magic that will make us achieve. No country has grown at that rate in the world to achieve a $1 trillion economy in 2030. But having said that, so it's good we moderate our expectations so that we don't get disappointed. The other part of your question is that we are talking of low purchasing power. Let me put it in proper context. You know, we talk about, we dwell a lot on inflation. The inflation rate we said is at about 20.12%. But that was based on a base of 33.18% for last year. So in effect, inflation rate over the past 18 months over the past 20 months is actually cumulated about 53.3%. Most households, no household, I don't know, let me not say no household. Most households have not had an income increase in their household income by 53.3%. So it then means that virtually no household in Nigeria can afford the same quantity of goods and services they afforded in December 2023. What that means is that they have very little disposable income. Their income, they can't afford the same quantity of goods and services. The increment we saw in minimum wage is not enough to meet the increase in average price of goods and services over the past 20 months. And that's why Nigerians are not able to make a lot of demand, which is manifesting in this very slow consumer goods sector. I mean, I'm sure you're aware that Shoprite said that Nigerians' income level do no longer support mega shops in Nigeria, and therefore they are going to restructure Shoprite. They're no longer going to have mega shop because we don't have disposable income. Before Nigerians will begin to feel the impact of a declining inflation is when their income increases above the rate of increase in inflation.
Exactly.
That's the only time when you have ability to afford more, and that's when your demand will improve. That's when you're going to see a lot more improvement in consumer spending.
Finally, on this case, the federal government definitely has a role to play in addressing fallout of these reforms. State governments have a role, but I'm going to ask you regarding MDAs of government, where you see them also coming up with some taxes and levies in some cases. Just last week, the controversial 4% FOB was, on imports, was actually waved away by Mr. President and all of that. My question really is, do you think that many of these agencies are working in tandem, in sync with government's ease of doing business initiative and all of that?
Well, what I would say is that if government to define what they want to prioritize on, it looks like either the body language or statement means that government is focused on increasing internally generated revenue. But every economic policy will have a pro and con, a positive and negative. When you overtax people whose disposable income is almost zero, whose disposable income is actually negative, what you do, you slow down the process of capital formation, you slow down the demand for goods and services. When you slow down demand for goods and services, you slow down production and you slow down employment creation. And that's why in economics we say tax is a leakage. Just like import is a leakage. When you take tax away from the citizens, you reduce the amount they will spend on goods and services. You reduce their capacity to save money and go into real sector productive activities, invest. So the government must define how do we want to grow the economy. So I think my approach, personal approach, is that emphasis should be let's bake the cake before we share it. Let's grow the trees. And then when the trees are big enough, they will yield enough fruit and we can harvest the fruit. Dubai did that. At some point when Dubai started their transformation, they had a zero tax rate. There was no value added tax. There was no tax. And companies were flooding to Dubai. Those companies that came to Dubai built the Dubai economy to whatever it is today. And Dubai has introduced taxes. So it's taking the fruits of the trees it planted. So if you eat the fruit without planting it, what will happen is that you're not going to have the trees. Your place will be a desert. So the government must review its approach to economic growth. And that's when the government does that and makes it clear that it's not just about taking resources from the citizens and companies. It's about supporting them to accumulate capital, supporting them to have enough to be able to feed and buy clothes so that manufacturers can the demand for manufactured goods. Those people will go and demand for input, including labor, and will create employment. And the economy will eventually, over time, grow and be in a position to pay those higher taxes without qualms.
Mr. Johnson Chukwu, is a good way to live it this Monday afternoon. I must thank you so very much for your contributions. Do have a great week. Founder, CEO, Carrier Assets Management Limited, Mr. Johnson Chukwu.